Hi, everybody. Jim Kruzan here, and welcome to the July Economic Update. Hope everybody's having a great summer so far. This will be a short review of just what happened last month, just to give you a general sense for what's going on. Some of this information, for those who have had recent reviews, may look very similar. Sorry about that. First and foremost, the LAI, we've been talking about that for 3 years, continues to drop. That's a problem. Doesn't mean there's an immediate concern, but it usually leads to recessionary times, and with valuations where they are, could lead to a pretty uncomfortable sell-off. Don't know when that is. Certainly hasn't happened yet, but it continues to somewhat sell off. So as a result, we are still remaining pretty cautious. Economic data is kind of spotty, especially for the month. A couple things to consider. This might be old news for some. We're waiting for the update right here on the credit card delinquencies. That'll come out actually next week. For the last 4 quarters in a row, the delinquency rates continue to rise, well in excess of 13% as we speak today. That's not a good sign. Typically, that's not what you'd expect to see if the expectation is the economy is improving. Consumers are nearly 70% of our economy, and eventually, as they go, so goes the economy. We're also still seeing a lot of weakness in commercial mortgages. Think of that as local banks that hold mortgage paper on office buildings. That number is just a hair under 12%, updated the first of the month, and it's up from the prior month. And not quite, but nearly at its all-time high. And that number is quite a bit higher than the high achieved during the financial crisis. So again, not a great environment to be in. If you look at the manufacturing, at least for the month of July, there was a bit of an uptick. And we saw it in just about every Federal Reserve Bank area. Overall, PMI numbers look good. New order numbers were improving slightly. Philly, Chicago, Empire State saw a bit of an uptick. These numbers can bounce around quite a bit, so we'll see what they look like. But that is certainly somewhat of a positive sign. A bit more troubling is the inflation rate, and it continues to remain fairly high. When we look at the PPI numbers, which are think of that as the input numbers, the wholesale numbers on a year-over-year basis, they're up nearly 5%. That eventually feeds into CPI, et cetera. And that's certainly one of the reasons that there's a lot of discussion on whether the Federal Reserve is going to raise rates here at some point. One thing that's keeping the Fed from raising, but also keeping it from cutting because of this inflation, is we're beginning to see some weakness in employment. And this is a slow moving train. But when we look at things like the ADP survey, which is the payroll processing survey, they added just 44,000 jobs, significantly less than the 75,000 expected, or 89 or 98,000 from the actual month before. They were expecting it to be weak, but nowhere near quite that weak. An interesting data point was the unemployment rate. This was just published this morning, and it actually showed that the unemployment rate dropped to 4.1 from 4.2. Investigating the reason why, it was the fact that there were fewer people seeking jobs. So people have either retired out or they have just stopped looking, and as a result, the numerator was adjusted, and as such, it dropped a bit. Another weak point, again released today, was the U.S. employment number. They were forecasting 83,000 jobs, and what was actually reported were 23,000. That's interesting because we had kind of discerning and deviating numbers just a month or so ago. The household survey, where the government calls up households and asks how many people are employed now versus a month ago, saw a huge drop in that number. And now we're beginning to see that filter into the employment number. So as a result, bonds are up a little bit today, one of the first times in the last couple of months where bonds have actually got an upward tick. On fear that the Fed may have to do something should the economy actually stall or move into a recession. The other thing that we've been dealing with, and I've been talking about for a while, is extreme valuations. When we look at where the stock market is, it's really, really expensive. When we look at things like the Buffett indicator, which is a measure to view market valuation, it's considered to be extremely strongly overvalued. At the end of March, we had numbers of 219, meaning the market was 219% of the GDP. Or another way of looking at that, we're well over 100% more than GDP. That number was down because the market was actually down in March. The high was 230, which was recorded in December. And if we look at where we are today, or as of August 5th, we exceed that number once again. We're now closer to 240. And you can see it's almost a parabolic move in terms of valuation. This can last for a while, but eventually the air comes out. Eventually the multiples contract. When you look at another method of viewing valuation, something that academics prefer, the Shiller method, where these assets are adjusted for a cyclicality of earnings, kind of a 10-year rolling average. And price is adjusted yearly by the prevailing inflation rate. So it's a measurable and comparable data set. We're at 42, which is as high as we've seen in years. The only time, by the way, this data goes back to 1870. The only time it ever exceeded that was just prior to the dot-com bubble when we had those extreme valuations. And we're really knocking on that door. Valuations today by the Shiller method are higher than they were going into the Great Depression in 29, higher than they were going into the horrible recession we had in the early 70s, or the financial crisis, or the dot-com crisis, or the peak that we had with all the mime stocks and SPACs and those things in 2020. Valuations are extreme. Taking a quick look at what happened during the month of July, a couple things. One, the S&P 500 was really pretty flat. Value stocks were actually up about 1%, so they have been outperforming since the beginning of the year. And the reason for that is big tech, specifically AI, has had a tougher go. They're still up on the year, certainly, but we're beginning to see some headwinds. And as of the month of July, the NASDAQ, both the composite and the NASDAQ 100, were both down for the month. The really interesting is in the middle of the chart, starting with the Barclays aggregate, right here, and looking at the next several units, those are all bonds. Aggregate is kind of the S&P 500 in bond land, corporate, as well as government. These are 1 to 3 year treasuries, 7 to 10 year treasuries, 20-year treasuries, and out. Any way you want to dice or slice it, they're all negative on the year. Some of you may have wondered why. In some of the IRA accounts, we've got a large amount of money market. Simply put, we can get a 3.6, almost 3.7% yield without any downside risk. I can buy a 5-year treasury at 4.2-ish% and see a 2+% drop in the value. The net return is far less than what we would get in money market. So that's what's happening there. As a result of the headwind on some of the AI, couple things happening. One, when you look at just the Mag 7, it still represents a huge percentage of the S&P, well over 33%. And when you take those 7 and add the next 3 largest companies within the S&P to look at the top 10, we're just a hair under 40. I'll remind you during the dot-com bubble, and everybody agrees it was in fact a bubble, the top 10 names of the most popular stocks back then represented about 20% of the index. That should give you some degree of comparison in terms of what size this bubble may very well be. Because the NASDAQ was down and the S&P was up, not a surprise that when you look at the percentage that the Meg 7 contribute to the S&P year to date, it's about 23% of its performance, and they represent 34% of the index, a bit of an underperformance against the broad-based market. But that's kind of where we are for the month of July. If you have any questions, as always, please reach out, give us a call, send us a message, whatever you would like to do. Otherwise, we'll do this again at the end of the month for August, and have a great rest of your summer. Talk to you later, and thanks for listening. Take care.